All right. So if you are a small business owner like me and you're like, how do I create a balance sheet? And I'm going to go step by step on how to create a balance sheet. A lot of times that'll be used for financing or so forth. And and I'm going to just show you exactly how to do it so that you know how to do it. Let's go. All right. Here's a balance sheet. Now, the cool thing about a balance sheet, it's a snapshot in time. So the income statement or uh yeah, it's basically it's like a picture, it's like a photo, where income statement is more like a movie, where it kind of like from one time to another time, it kind of gives an explanation of what happened. Balance sheet would be like based on what with that date and time. So where it says a date, what where things are at this particular moment. And typically, a lot of times, the balance sheet and the income statement you want to have the similar, if not the same, um, ending date. So the assets, these are all the things that the business owns. Okay. And so if you've ever done a personal financial statement, you have your assets and your liabilities. Well, the business also has assets and liabilities. Typically, what's titled in the business is typically those assets. So you got your cash. And so let's just say if this is the ending date of the end of the month, and whatever the ending amount that's in your checking account, that would go here under cash, right? And that could be in your checking account or your savings account, right? And then accounts receivable, what account receivable is, those that's money that's owed to you, right? and and whatever whatever somebody's it says less doubtful accounts. So typically, if somebody owes you more money and it's beyond 90 or 120 days, um, unfortunately, in my experience, it's hard to after that amount of time, it's hard to collect. But like if you truly in your daily operations, your business, you send out IOUs, which are invoices, and typically they get paid in 30, 45, 60 days. And that's an asset. It's not cash because you haven't collected it, right? But it is account receivable. And there's financial institutions that sometimes will advance on that. And then inventory. Let's just say you sell equipment, right? Well, how much equipment do you have in there in your possession and how much is worth? That would be inventory. I mean, if you're a retail establishment and you sell snow cones, the ice would be inventory. Maybe it may be like the cups and the little, what do you call it? The sugar, flavored sugar that you put over top. Though all of that stuff, whatever that's worth, is what's your inventory. Temporary investment. So that could be money that you've invested into the business, like uh maybe um I don't know. Guess what would be some good things on there, but like you invested in maybe not necessarily equipment, but some know-how that's truly valuable that you can put on here. Uh prepaid expenses, that would mean like if you prepaid maybe some bills or something like that ahead of time before it got invoiced or owed to you. And so long-term investments, something like stocks and bonds that the business owns, that could be long-term investments. Land, buildings, less accumulated depreciation. And depreciation, what depreciation is, if you don't know what that is, it is typically like, let's just say you buy a car for 25 grand. As soon as you drive it off the lot, if you had to sell it to someone, how much is that 20, $25,000 car? Was probably lost, I don't know, $2,000 right off the bat. Well, that would be the depreciation cost. Plant and equipment, so less depreciation. We talked about lease depreciation, furniture and fixtures. Anything that the company owns would fall on the current assets, and then you title uh you add that all up. And if you put it in here, this in this spreadsheet, it'll add it up for you. And then you got current liabilities. Now, current liabilities or assets are things that you own. Liabilities are things that you owe. So, like for as far as account receivable, this is money that uh, pe people people owe you. Accounts payable is when you owe someone else. And short-term notes, maybe it's not necessarily like a mortgage or a long-term loan, but like those would be like short-term notes, maybe net 30, net maybe 30 days, 60 days, 90 days that you owe per a current portion of long-term notes. Maybe that's not the whole notes, but like fees that maybe you owe or something like that. Interest payable, like maybe you owe somebody interest. You owe somebody interest, like and accrued payroll. So maybe this is money that you owe somebody for working for you, but it's you know, but it's not expense yet, right? And then one of the things that you would kind of a balance sheet. The great thing about the balance sheet is it balances, right? And so typically all the liabilities that you owe, minus the assets, hopefully you have more assets than you have liabilities. And then that means right here, you'll have retained earnings. So like the capital stock. So like typically, let's just say it's 100,000 here, you owe 50,000, you have 100,000 in assets, but only 50,000 in current short-term and long-term liabilities. And and what is left over is your equity. So let's just say that would be $50,000. And so that would be because the total liabilities and equity would need to balance out. And and I tell everybody, do the best you can and always, seek a professional. But like, but here's something that you could use for yourself or for others to show, how much your business is worth, right? Obviously always get professional but help, but like but hey, that's so easy. Well, let's just cut this short. Now, if you have any questions that I didn't do a good job of explaining, put that in the quote, and if you haven't watched the income statement, the personal financial statement video, definitely watch that one on how to fill out a income statement or a profit and loss statement. All right, thanks for watching.